Markets and bring in Eva Ados. She is COO of ER Shares. Eva, always good to see you. I'm curious if yesterday's Federal Reserve meeting changed the way you are approaching portfolios here in the fourth quarter.
Definitely. I think they are paving the way for a very strong year-end. Tapering was largely factored in. They made it clear that they're going to push interest rate hikes until we see full employment. And now that's an ambiguous term. We think it means going back to pre-pandemic levels of 3.5% to 4% unemployment. Now, that was a 60-year low. We're right now at 4.8%, 1% below the 70-year historical average of 5.8%. We think that 1% going back to 3.5 to 4% will be the toughest to achieve. And the reasons are socioeconomic. We have an unprecedented amount of the workforce retiring. That's baby boomers, 75 million baby boomers retiring with a rate of 2 to 3 million a year. That's a disproportionate amount of the workforce. The available workforce does not necessarily have the skills to fill these positions. Then at the low end, you have available open positions. They're not necessarily attractive, but by the workforce that we have available. So it's a unique scenario. We think it's going to take some time, and that's the reason why the markets are reacting in such a positive manner.
So you think even with the unwinding, there's still bond buying going on, the environment still supports equities?
Definitely. I think there's no better place to be right now than equities. In fact, I prefer technology, small caps, high risk, even companies with no profits but very high growth. I think we're going to see a return to technology in November and December. And the reason is that towards the end of a bull year, cyclicals have so much money to fuel back into technology solutions such as cybersecurity. We saw last 2 weeks ago, Tesla, the Hertz deal, 100,000 Teslas at full price. That's unseen. They usually do it at a discount. So that shows us the strength of the market, how much power the cyclicals now have. And this is the time when they want to prepare for an inflationary environment where automating your operations is key, and technology will be there to help them.
You know, there's been a spotlight shown on Metaverse, especially now that Facebook has changed its name to Meta. Where do you see opportunities in that space? What do you like right now?
I'm a big fan. I think that it's going to shape our future. I truly believe that. And the reason is it has such a wide array of applications. It goes from retail to online commerce, real estate, communication. It's such a wide array of applications that even if it's not successful in one of them, it will be in others. And that's why I think it's really hard to not be successful in the future. I also like it because it brings so many technologies together. We built amazing technologies over the last years, blockchain, AI, Internet of Things, augmented reality. It brings them all together, and it's really hard to grasp the potential of it in the future because you have new use cases, new behaviors emerging from bringing all these technologies together.
I want to know what your inflation outlook is, because I've heard, people saying different things about stagflation. Is it an issue? Is it a concern? Is it not? What is your outlook, and when do you think things will start to cool down a little bit?
I'm optimistic. I think we'll see it stabilizing, if not even drop. I'm not saying we're going back to below 2%, but I think that China, many analysts are not incorporating in their estimates the China slowdown. That's derived by the Evergrande crisis. You have the energy crisis. You have zero COVID tolerance policies. They're all bringing down China's economy, and that will reverberate across the world. We're already seeing and also 50% of the dollar-denominated distressed debt exists right now in China, they'll have a very hard time refinancing it. And for that reason, I think that's going to pull down the economy. We saw 2 weeks ago, commodities dropped by 16%. This is highly correlated to the drop and rise in construction. We might see more of this. It's going to put a downward pressure on prices around the world, and I think it's going to help us with inflation.
And I know that you say you like equities right now over all other asset classes, but what about outside the U.S.? You touched on China there and things that we need to look out for, but where are you putting some resources outside of U.S. equities?
I would go for Europe and Japan. Not touching China at this moment. In fact, we have been decreasing our position significantly to minor investments. I wouldn't advocate more than a small risk amount of capital in China. And the reasons are we will see unforeseen events again with China. We had overnight announcements that affected IPOs, existing or future IPOs. So I think the risk is much higher. The expected return when it comes to China is much lower. You have, you have the slowdown of the economy. I don't see a big reason why people would invest in China right now.
All right, Eva Ados, COO of ER Shares. Always great to have you on the show.